Time now for a Bloomberg exclusive with a major player in the mortgage market. Bloomberg's Erik Schatzker sat down with Josh Friedman, co-chairman and co-CEO of Canyon Partners.
Well, we've started to use CMBX triple B minus layers as a way to provide a hedge with maybe some optionality in a downturn as well. Partly because of weakening fundamentals in the underlying credits, partly because weakening structural characteristics of those instruments themselves.
How big a deal is this for the firm?
It's enough to provide a fair bit of insurance in downturns. We saw it actually helped quite a lot in December. We're looking at the characteristics of some of the underlying properties. CMBX inherently has some of the lower quality commercial real estate mortgages as part of its asset base. But today, the percentage of those assets that are interest-only loans, for example, has increased quite dramatically. Earnings are starting to miss projections and are actually down in some of the fundamentals, fundamental credits, as opposed to being projected to be up. So you've actually got loan-to-values that are comfortably above 100% in a fair bit of some of those portfolios, even though they're still paying coupons.
Josh, some people say that what's happening in commercial real estate today is reminiscent of what was happening in residential mortgages before the financial crisis. Do you see those parallels?
I think it's a bit of an overstatement, frankly. I think that the layers in the RMBS world, the residential world, were very, very thin layers piled at the very bottom underneath heaps of senior debt. And there were practices that were causing excessive issuance of poor mortgages back then. I wouldn't quite say that's the case with commercial. However, we shouldn't forget that commercial real estate is 173% of the value it was at the peak before the crash in 2008, whereas residential is only at 110%. So there's a good bit of room to fall, particularly if rates rise and cap rates go up.
So prices are 73% higher than the previous peak.
Yes, they are. And that's facing some secular headwinds as well. You know, we've heard a lot about retailing and how retailing's being hurt, but, you know, we have something like 8 times the square footage of Germany per capita of retailing. We just don't need all that retail space.
But that's where I go back to resi mortgages. And again, I know you say the parallels are overstated, but there's some things that are the same, right? There's oversupply, valuations may be stretched, the fundamentals appear to be deteriorating, and at least in a structured product, there's deteriorating, like collateral quality, structural quality. Those are all kind of the same.
Yeah, I just wouldn't get quite as alarmist about it.
I'm not too excited about it.
I love it. It's a great hedge. It works well. It goes against the market. It has structural headwinds. Credit deterioration and bad lending practices have helped. And you have the basic issue of retail being overstored. So I think that's all great. But in residential mortgages, you had an incentive to have massive amounts of issuance with essentially no down payments, causing no price discipline, as well as a healthy amount of poor documentation and other things. I think some of the things in residential were just, they were almost a caricature of the extremes of the market, and I don't think that's the same thing with commercial mortgages. But I do think they're an awfully good short right now.
Give me a sense of scale. You're a call it $25 billion firm. This accounts for how much of your NAV?
A little in excess of $1 billion.
Okay. That's substantial. And when you talk about hedging and the need to hedge at this point, would you say that Canyon overall is being cautious about how it's positioning in the financial markets?
Yeah, our long exposure is probably less than it's been any time in recent memory. Our equity exposure, including post-bankrupt equities and arbitrage and just value equities, is something below half or around half of what it was maybe last April or so. We saw the fragility of the market in December, and we think there are a lot of warnings in the overall macroeconomy that are more than just more than just noise today, that are a real signal. You're seeing fundamental weakening in China. You're seeing fundamental weakening in Europe. You've really seen the limits of monetary and fiscal policy in its ability to extend out a long boom period. Rates are low everywhere. It's hard to see rates being any lower than they are today. Draghi, when he spoke about interest rates and pushing off any reversal of quantitative easing, you could read that either as a bullish signal, great, rates are going to stay low, or you could read that as a sign of fear. I read it more as a sign of fear about the slowdown in Europe. And we are part of a global economy. So I think that it's time to be a bit cautious.
How do you express that caution?
Well, first of all, by lowering total exposures. Second of all, by having shorter duration, more event-oriented situations where they're much less market dependent. Third of all is by adding hedges like what we talked about on CMBX, and generally constructing a portfolio that's going to be less correlated to things like duration, interest rates, overall beta, overall market exposure, et cetera. I watch the daily fluctuation of our pricing versus, for example, almost any market index, any type of beta for what that's worth, and we've really consciously dropped that very dramatically.
How big a cash position do you have now?
I'd say well over 20% right now.
And that's relative to, say, what, a year ago?
Close to flat cash.